Welcome to Yahoo Finance's Morning Brief. I am Julie Hyman, and joining us today is Liz Hoffman. She's Semaphor's editor for business and finance, and she's also host of a new podcast, Semaphor's Compound Interest podcast. So Liz, it's great to have you here.
Thanks for having me, Julie. It was good to see you.
So obviously it has been an eventful few weeks, both in real life, right, and what's happening with the war in Iran, and also in the markets. And sometimes there's been this interesting sort of disconnect between the two. I was just running the numbers this morning. Right now, the S&P 500 is now down about 4% from when this all began. WTI crude, I know that what these numbers are, but even as I look at them, it's still just so astonishing that WTI and Brent are each up. WTI about 43.5%, Brent up about 50% just since this began. I was looking at some tweets this morning about the oil futures curve, that even though the curve shows there's an expectation prices will come down from here, they're still higher than where they were before. And, you know, I know that you talk to a lot of CEOs, a lot of deal makers, and I'm curious what you're hearing about, like what they're making of this environment, and also that interesting disconnect that stocks just are not hit as much as you might think.
Yeah, so oil is way up, as it should be. This is a major supply shock, right? And you cannot kind of finance or paper your way out of it. There's a lot less oil hitting the market than there used to be. Oil should be up. And then you look around at what are the derivative effects of that. Obviously, refined oil products, gasoline, diesel. If it goes on long enough, you're going to see it in plastics and polymers. You're already seeing it in fertilizer, right. And America is a truck to store nation. So eventually that is going to flow through to commercial transportation costs, and it's going to be a problem. I think that the relatively contained blast radius, when you look across other financial markets, probably reflects more cross currents of a lot of other stuff. And I think investors are saying, I don't know, right? But just go back before, the fighting in Iran started. You had an economy that was being pulled in two very different directions: stubbornly high inflation and a weakening job market. And into that, and that has different policy answers, right? One of them, you should raise interest rates. One of them, you should probably think about cutting them. And then into that, we got these two additional pulls in opposite directions: this huge supply shock, which is going to, as we just said, raise costs in a bunch of different areas. And then the acceleration of the AI job wipeout, which we can talk about how real that is and when that's coming. But so those two countervailing forces put just a lot of confusion and pressure in the economy. And sometimes the easiest thing to do is just sit on your hands.
Yeah, I mean, I think there's a lot of that. I think there's also, there's this, as Ed Denny wrote in a note, the financial markets seem to be expecting a short war. Even as it does go on for several weeks here, we don't really know where it's going to end. And equity investors seem to be betting that, okay, whether it's short, whatever short means, right, whether it's a month or 2 months or 6 months, at some point it will end. And the bet seems to be that when it ends, that then will revert to our upward momentum, and that they don't want to miss that upward momentum whenever it does end. Now, maybe as we get into 2 months in, that feeling, that sentiment will start to wane a little bit. But for now, it seems like the fear of missing out when it does end, or when not even when it ends, but when you get a positive headline, and that, okay, we don't want to miss out on that upside, that little spike when that happens. That still seems to be somewhat in effect here. But to your point, and the cross currents, you also have the other thing. I'm also looking at other assets, like the 10-year yield is up 31 basis points since this started, which is an equally astonishing move and indicates that there is real concern about what this is going to do to inflation in a more substantial way. And I've been trying to piece out with people that I speak to here, like, when does that inflation concern tip into a growth concern that maybe will have a more fundamental effect, and maybe will cause people to finally not sit on their hands anymore? And it's not entirely clear. I think that the bond market will maybe guide the way on that and will help provide some signal, but it's not sending that signal right now for sure.
No, and I would be looking to the bond market and not the equity market for those signals. If you go back, this time last year, Liberation Day, the reins ultimately got tugged, obviously, by the fixed income market. Yeah, I mean, the other question though is, okay, let's say you're scared and you do kind of want to run. Where are you going to go? Like, not that much looks that good right now.
Yeah, you can't go to gold, point, which is where you could have gone
can't go
before.
to gold,
yeah,
which is down. Like, there's maybe parts of the yield curve that are attractive. I saw Citadel just kind of abandoned its bearish call the other day on the short end. But you're talking about the long end too, and the charitable way to look at yields going up there is, well, we think there's going to be more growth. And so we're going to be, in a different environment down the road. Obviously, the scary one is, there's going to be really high inflation, which is ultimately, the most, the thing that brings inflation down is recessions. So yeah. I don't know. There aren't a lot of great places to go. Other kind of asset classes du jour. We can talk about private credit to your heart's content. But there's places that are a lot less attractive for totally unrelated cyclical reasons than they were 6 months ago.
Yeah, I mean, the one part of the market, of the equity market at least, that's worked consistently over this time has been energy stocks, which is no surprise, which are up not just, I mean, they started to rise even before the war happened. They are up considerably year to date, and they're doing well during this period of time. But, obviously you're making a different kind of bet if you get into especially if you haven't gotten into them already and you're getting into them now. You then obviously run the risk of getting in and then seeing the rug being pulled out from under you when we see oil prices come back down. I've got oil on my mind because I'm going to CERAWeek in Houston early next week, which is the industry's big conference, oil and gas and also power. And I imagine there's going to be a lot of talk and a lot of reckoning around this. Apparently, the White House has been asking these guys to produce more. But, the issue is, the stuff that we produce in the U.S. isn't the kind of oil that we need to refine into gasoline. We still need to import some of that. And secondly, these guys want to see that they don't want to just see prices go up for a little bit and start to pump more. They want to see that it be higher for a more sustained period of time. So the administration really doesn't seem to have that many levers to pull in that area.
Yeah, and remember, it was, if you go back 10 years, and that's the time horizon that particularly CapEx intensive investors and CEOs are operating under. And they remember when they just drilled themselves into oblivion in the early 2010s. And it was great for all of us. We got cheap gas and energy independence, and shareholders just got wiped out. That whole generation of wildcatters just totally spent themselves into bankruptcy. And they do not want to do that again.
No, the lessons seem to have been learned from that period of time for sure. Something else I wanted to ask you about, sort of related to all of this, is you're really steeped in M&A and the deal-making space. And we've seen, kind of things go quiet on that front, right? We've had some IPOs get pulled. And I wonder, are those guys waiting for this to reach some kind of conclusion or signal a conclusion before we see them coming back to the market? I mean, the market turmoil doesn't help, obviously, either.
Yeah, I think there's sort of two big dynamics at play in the M&A market. As you say, I started as an M&A reporter, and you can never quite outrun that beat once you've been on it. One is just the uncertainty and the volatility. And that's partly emotional, but it's also partly, basic M&A analysis is running a discounted cash flow on a set of assets. And there's a lot of inputs into that. But if you can't figure out what they're going to be worth, you can't, in good conscience, play for them. Unless you're, a media mogul and you really want to own a Hollywood studio, and then you can you just bid yourself up. But so that's one. The other, though, that I think is pushing in the other direction is AI. And I think AI is becoming a major factor in M&A, not quite for the reasons that you might think. It's not that AI is going to eat my business, so I have to go buy another business before that happens, or else I'm not going to have a company to run. It's more, AI is going to change every business. And if you are trying to be front-footed as a CEO, you want to put the AI on top of the biggest business that you can. So you're starting to see, I think, kind of what you might think of as kind of late stage, horizontal consolidation. So they say, let's smash these two big railroads together. There's chatter about an airline deal. I don't know, we'll see. But if you're going to take these big companies, smash them together, and then put AI on top of that, this is kind of the time to do it. So I think there's a real push and pull. You're talking about CERAWeek, the M&A Bars big conference is happening yesterday and today down in New Orleans. So we'll get a temperature check. Though I would note that last year the mood there was pretty bad, and it ended up being, I think, the second best year on record for deals. And the other force, by the way, is that Washington is totally open for M&A.
Right.
There was that big turnover in the antitrust division at the Department of Justice, and the takeaway from that was that they sort of fired the woman who was seen anyway as being a little skeptical of consolidation, and so the rug has been rolled out there.
Yeah, most definitely. Although, we'll still see if the Paramount WBD deal gets any scrutiny. That'll be a fun one. So as we're talking about AI, as we're talking about that consolidation, I was struck by the headline, well, a couple headlines on that front in terms of the labor market. We heard that Block had hired back some people of the 4,000 it had laid off, but it sounded like that was sort of just at the margin, like they called them clerical errors. In one case, the head of a division had advocated for some of his people to be added back, and they bought that. And then the other one is Crypto.com cutting about 12% of its staff. But I was struck there, even as the CEO talked about, we're integrating enterprise-wide AI. This is not the first layoff that Crypto.com has done, and the last round didn't seem to have anything to do with AI. Oh, and by the way, crypto is down, whatever percent from its high. Bitcoin is down whatever percent from its highs. So, we are still left in this position of trying to tease out what is really about AI, what is really just about where we are in the economic cycle and how these businesses are doing. And I know that's a separate question from how AI is going to change the labor force, but I still think, it's a question that I think we as journalists and anyone who's looking at these companies is trying to grapple with.
Yeah, I think at the moment, perhaps with the exception of the layoffs that appear to be coming at Meta, which where Mark has really talked about how it is actually already dramatically changing their the way they develop and ship code. I think everywhere else it is basically air cover for layoffs that companies have wanted to do. Remember, companies overhired in the pandemic. They underfired on the way out because they didn't want to look cruel and heartless, and they are sort of structurally probably they're a little bloated right now. I think that the technology is just not good enough and definitely not integrated enough into workflows at any company outside of a handful of tech guys who really know what they're doing with it to justify these layoffs. As you say, crypto is down, and I don't know Crypto.com's business model, intimately, but I assume it relies heavily on advertising from crypto companies. And, as the air comes out of that market, there's just going to be less money and they need to tighten their belts.
Yeah, and we were talking yesterday about the FT had cited the head of PwC's U.S. business as saying, everybody has to use AI. And the discussion we've been having here is a lot about how AI right now is a push, not a pull, and that it's, to your point, it's really not integrated in businesses, in part because people don't want to use it that much.
Yeah.
They'll use it some. I think people get it to some extent. But I think also they haven't been, there's an emotional resistance because they feel there is a risk that they are replaceable, maybe. And B, it's just my job works well right now. I'm sure a lot of people are thinking, what am I going to use it for exactly? And so I think that the runway perhaps to kind of close that gap is maybe larger. Even as much as companies might want it to be smaller and might try and force it down people's throats, I think it's going to take a while.
I do too. I think there's real resistance to this, both in people's day-to-day jobs, but you're also just starting to see the political backlash to this. This technology is just really unpopular for very understandable reasons. And so I think that is true. But also, I'm sure that is what they said about the tractor when it showed up, that the horses did the job just fine. And it turns out that people who made the switch were more productive and prospered. And so I think this is sort of a one-way street. And I'm sure you keep hearing the same line I do, which is that your job's not going to be taken by AI. It's going to be taken by someone who knows how to use AI. And that actually seems annoying, but probably true to me. Yeah,
I do think that people who say every technological thing that's come forward, people have been unhappy about it. That's not I feel like, my co-anchor Miles Udland brought up Facebook the other day, and he said when Facebook came, people thought it was the coolest thing ever, right? People, it was this really fun and new thing that opened avenues that we hadn't seen before. But I guess we're not at that point yet. We're more at the here's the internet point, right? In other words, we haven't had the applications really layered on AI yet to truly understand what it can do, and maybe then people will be more excited about the utility. I don't know. I don't know how it's all going to turn out.
I think no, and I think it's actually a big test of venture and what they're building behind right now. Because everyone loved Facebook. There was a decade of consumer apps that were really fun and they were like great and also probably
until they weren't
chemically addictive. Yes, exactly. But they're pushing on much heavier stuff right now and things that people don't innately like pick up and love and know how to use. And so I don't know. I think that is a big test of just the gargantuan sums of money that are being thrown around here.
Yeah, exactly. And, I know that you talked to Larry Fink recently about AI and jobs and sort of what kinds of jobs the next generation is maybe going to need to focus on. And I think it's like almost become cliche at this point that like, my high school junior, like maybe he should become a plumber. I don't think he has any interest in becoming a plumber, but he would have better job security maybe if that's the direction he went. So there is like, there are these questions about whether there's going to be this lost generation of young workers who are trying to figure out how to find a place in all of this.
Yeah, and the one thing that Larry said that stuck with me was that the class coming out, the May of 2026 cohort, like, boy, is that one to keep an eye on. I think they have a real skills gap. And though I am slightly terrified of middle and high schoolers right now. So
yeah.
I mean, no, but honestly, the comparison is the right one. Like you and I were sort of we grew up with the internet, I think. And then there's a group that grew up with mobile. I don't know how sort of professionally valuable that native skill was, but probably something. But the native AI workers and the native AI companies, I think, are really going to be kind of, the next thing to watch.
Yeah, what I always think about with that like internet to mobile transition is we never stopped working. Before then, we could stop.
You could stop working, yeah.
Now you can't. There's no stopping.
But now the agents are going to work for you, I guess. I don't know. It all sounds exhausting.
Oh yeah, we'll see. I want to turn to another interesting headline that caught my eye, which is that Jeff Bezos is going Massasohn. He is at least reportedly in early discussions to raise as much as $100 billion for an investment fund. At the same time, I had missed this, I guess, that he's co-CEO of something called Project Prometheus, which is basically trying to combine AI and bring it into the physical world, among other things. So sort of doing research into different things. And I just, I wonder, like, I don't know. I just think it's a really interesting move on his part. Obviously, we think of him as so intertwined with Amazon and the Washington Post for good and for ill. And now he's going in a different direction. But I think physical AI is going to be an area that is going to be more interesting as time goes on too.
Yeah, every technological advance, it starts sort of as an academic project and then becomes applied. And then, that application layer is where a lot of the value ultimately accrues. It's interesting. I saw the story, and I don't know exactly what the tie-in is, but when you look at the companies that are investing heavily in AI, Amazon is actually the outlier because that's a very physical business, a very logistical heavy business. And, I was reading the story and it was saying maybe AI can predict how the air is going to go around the plane wing and what that means for ground speed. Like, I don't know if Amazon can pick up 5 minutes on a cross-country flight and get that thing to my door, 5 minutes faster. I don't know that it's worth $100 billion, but the application of physical AI there is interesting. I will say, though, I covered the SoftBank Vision Fund. I remain, kind of scarred as a reporter by watching that experience. If I'm making like the bull case for something like this, and I've written a lot about this recently, that venture is just raising way more money than they ever did before and investing in a totally different type of thing. These are guys that grew up investing in infinitely scalable code, literally light things that just didn't weigh very much. And now they're huge into defense and energy and robotics and mining. And, if you're going to make the argument as to why it will work better this time, it is perhaps that Massasohn was investing 2026 levels of money, $100 billion, into 2016, 17, 18 business models. These kind of very like capital light marketplaces, mostly solving stupid consumer problems, like giving us, what was that, tech-enabled juicer? Like that was dumb. And that, perhaps there are some more substantive capital-intensive business models that can absorb that kind of venture capital money into productive things and not just throwing insane tequila parties. We'll see.
I mean, I don't know why people keep calling things Prometheus. I mean, yes, he brought fire to humans, but then he was tortured for eternity for doing so.
Yeah, it didn't go great. And, Peter Thiel's whole thing, all of his ventures are named after Lord of the Rings. Like, there is some cultural disconnect between the guys who appear to be building our future and the people they're building it for.
Yeah, there's a lot. I mean, listen, I'm a Lord of the Rings fan. So that doesn't. But to your point, like,
it all sounds a little ominous, though.
It does sound a little ominous. And there's the earlier point we made that, like, the Valley loves AI, the rest of the world does not. So, like, there's that disconnect too that people are not.
It needs like a Labubu frontman, something that's a little cuddlier.
Little K-pop Demon Hunters avatar to sing us all into doom, I guess. I don't know. Lastly, speaking of AI, there has been an AI written novel. I'm sure there's lots of AI written novels, but there was a novel called Shy Girl that was picked up. It was first it was self-published, then Hachette picked it up and published it in the UK. And then all these people said, this was written by AI. And they said, oh, we better not. They pulled it from the UK. They said they're not going to publish it in the US anymore. And it wasn't a very big, I think 1,800 copies of this thing sold, but the publishing industry is among the many industries that has a problem to contend with here to figure out if the stuff that's come through the door was written by humans or not, because people still seem to really want things written by humans, at least. I guess that's the silver lining of all of this.
Yeah, it's funny. We had a story last week that the hottest word in corporate earnings is moat, right? Every company wants to tell you about their AI moat. And a lot of them are sort of technical, but Etsy's, their CEO was saying their moat is this sort of fatigue with AI slop and a desire to kind of return to, handmade, tailored, like things that feel high quality. There's an element of that you can kind of see come through in the arguments that Trump administration was making about, well, the American dream shouldn't be buying cheap stuff from China, right? And there is like AI slop is some, digital version of cheap stuff from China. I don't know how you police it. Like, this is going to be, you're seeing in academia and higher ed now, this arms race between teachers and students. I honestly, I do not have a good answer for it. At the moment, you can kind of tell when something is written by AI. Yeah. There is a rhythm to it, and sort of it's like bad
words they use.
Aaron Sorkin speech writing or something. Yeah, there's something about it that's recognizable. But I think, that will get harder and harder. And for people in the other side of publishing, your business and mine, like it's something to contend with. When you're getting information and it's hard to know what to trust. I think that is a real problem. So I worry less about like the kind of like romance novel publishing industry, but the part of media that is really fact-based is just going to have to contend with that.
Well, and I think the idea that, these readers who are reading it closely and noting it, maybe everyday readers who are looking at your articles or Yahoo Finance don't, or social media, more to the point, they're not looking for those cues necessarily that things are not human generated.
Yeah.
Maybe.
Honestly, maybe that like the joke, remember when that CEO was caught on the Jumbotron cheating on his wife?
Sure.
That like the Jumbotron may be the last like true source of truth. Like it's happening right up there and 50,000 people are watching it, and live television like we're doing now is probably a close second. But it is gonna be hard, and that is a real, ultimately a political problem.
Well, on that cheery note, Liz, I hope you have a great Friday and a great weekend. Thank you so much for doing this.
Thanks, Julie. This was fun.
Appreciate it. Take care. And that does it for Morning Brief. Brian Sazzi has you for the next half hour on Opening Bid.
TGIF, I'm coming to you live from Yahoo Finance headquarters in New York City. So much to get to ahead of the weekend, so little time. Here are two brief things on my mind right now. First, I know FedEx shares are rallying on earnings, but I don't care. I'm giving this company 2 thumbs down today for another horrible earnings call where they say generally nothing of use to investors. No comments on the state of an economy getting slammed by an unplanned Middle East war. No comments on how surging diesel costs are going to impact the trucking industry. Nothing of use, which of course is what FedEx execs want. Keep it boring and keep it moving. 2, Goldman Sachs out this morning, not ruling out oil prices taking out the 2008 highs around $150 a barrel. Love to see this stuff before another weekend of oil infrastructure uncertainty. I am kidding. You do not love to see it. You do not want to see it at all. Here on the Opening Bid Roundtable, Tom Sosnoff, Lost Dog founder and CEO, and Lee Munson, Portfolio Wealth Advisors, President and CIO. Good to see you, gents. Coming in hot to you, Tom, this has been a wild week. We've seen a lot of wild moves in oil, not so much the broader market. Where is your head at going into the weekend?
Well, it's been a fun week of trading oil, Brian, that's for sure. My head in oil is we are going to stay. I don't really like that Goldman Sachs report that you just talked about. I think oil is going to stay very much range bound. I like the 80 to 115 range, and I think it's a short premium play as far as traders go.
Tom, how have you been trading oil in this topsy-turvy backdrop?
I've been really active in there, actually. I would say the last 2 weeks, probably traded more oil than I have in a couple of years. Mostly using the option markets and mostly using out of the money calls and puts. I feel like most traders in there, because volatility just got so high, the easiest play on the board was just to sell premium.
Lee, I talked to you a couple days ago, man, and we're basically still where we are in terms of the S&P 500, though oil prices are higher. Help me understand, why has this market been so resilient?
Well, I think bottom line is people aren't analyzing. People have that FOMO. People are afraid that Trump's going to chicken out and that peace is going to break out tomorrow. I don't think they understand oil infrastructure. I don't think they understand the Qatar Iranian fields, and that we've got 25% of LNG that's been taken off the market, and some of this stuff. 20% is that supply there out in those fields. It's going to take 3 to 5 years, not 3 to 5 months, not 3 to 5 weeks. This isn't just a little pothole in Boston. This is going to take 3 to 5 years to correct. So until we really see oil at 110, and I'm speaking as an investor versus a trader, 110, 120, then every analyst knows this is going to bake its way into earnings. You're going to start seeing all my favorite places, my small cap value, my large cap value. You're going to start seeing those earnings start to drop. Input prices are going to go up, and that's where the magic's going to happen. So the fact that we just barely got yesterday 5% off the all-time highs on broad-based markets like the S&P 500 tells me reality is starting to seep in. And I think over this weekend, people are going to start having that moment where they think, wait a minute, a delayed reaction doesn't mean there won't be one.
Lee, you're right on. This is not a pothole in Boston. Thank you for saying that. And to your point on earnings estimates, I very much agree with you. This view that we're still going to get double-digit earnings growth this year, to me, seems absolutely far-fetched. When is that major reset moment, and how severe could we see estimates come down?
Well, we're going to get earnings season right here in April, right? We're going to start. It's going to happen in the next few weeks. I'm not concerned about NVIDIA. They're going to be way far out. Also, all the chips, all that stuff, it's going to take a while before they start talking to the general public about why do we care about helium from the Middle East? Why is that an input? That's not going to happen at first. I think what you're going to see is in another few weeks, when people realize this isn't going to end real quick, you're going to start seeing industrials, your banks, tanks, cranks, they're going to start talking about, hey, forward guidance. What if this keeps on for another 8 weeks? And it's not about the war stopping. That's not really the key issue. I think we could wrap this up in 2 months. The issue is if that infrastructure gets banged up, suspending the Jones Act isn't going to make any difference. So it's going to happen in April. It's going to happen when we start getting forward guidance. And so I think if people really think we're going to get a 10, 15% correction, we may have to wait till spring break's over.
Tom, I know you and I have talked about this a lot. You are a contrarian investor. Are you a little perhaps more optimistic than some are starting to get in the markets here? I mean, we got Goldman Sachs out, I think it was yesterday, suggesting we might be headed to some form of correction. Nobody's calling a bear market. That's good. I like to see that stuff. But like, where are you thinking at right now?
I'm a little on the, I'm leaning on the short side here. I just don't, I don't think the risk reward favors buying this dip yet. I think it's just too little. I'd love to see a little more capitulation. What scares me the most is probably the tape action in the bond market. I didn't think we'd see the long bond back down to 113.20, and in this range here, I have a hard time seeing how the stock market's going to, how earnings or anything else is going to really prop up the stock market. I'd like to see, not necessarily a washout, but I'd like to see it grind down a few hundred more points, maybe another 5 or 7% in the S&Ps. And then I think things can get a little bit interesting. Right now, I think things are, let's say they're fairly priced, and I don't love the risk reward here. I don't think there's great pot odds for being long.
Hearing you're short, Tom, that's worrying me. Now I'm getting worried.
No, don't let that worry you, because I think I'm as a premium seller, I'm always short.
Okay, all right, fair enough. Are you trading anything in gold, Tom? And we saw the bottom drop out of gold prices yesterday. Yeah,
been very active. This has been the year for, instead of meme stocks, these are meme commodities this year. So gold, silver, and crude oil have been the biggest trades on the board for myself and for most retail investors. I have been trading a lot of gold and silver, along with crude oil. And the gold move and the silver move the last couple of days have been wild. It's quiet. It's all quiet this morning. But I don't think, if you're looking for the most opportunity and quote, the most noise in the markets, gold, silver have really been it all year.
Lee, isn't this a great backdrop to own gold on a pullback? I mean, the world seems like it's going to hell in a handbasket. Isn't this the backdrop for gold?
Gold isn't my thing. I used to trade gold all the time, and I get it. But here's the problem. Gold's getting crushed because rate expectations changed. I mean, look at the European Central Bank. They're looking at hiking. Look at the rate structure. That is a big, huge negative for gold, because once we stop this, phase of this war where we're bombing all the time and peace breaks out, so to speak, the infrastructure is not going to be done. But when peace breaks out, there's not going to be that reason to have the crisis. But look at what's causing gold to drop. It has to do with the Fed. It has to do with the European Central Bank. Remember, gold is priced in every single currency. I think you've got more downside. Now, I'm not saying you can't trade it, but from an investment perspective, the real play right now is waiting to see those long-dated treasuries above a 5 handle, and then that becomes a real asset that you can go straight into low growth expectations going into the rest of this year. You can go straight into lower earnings and watch that 30-year just drip lower and lower and lower and make some real money. But again, I'm the opposite of Tom. I got to invest for a bunch of retired people, and that's all their money. I think that we're basically on the same side. I think that the juice isn't worth the squeeze right now. I would rather play long duration treasuries at the right time than mess around with gold as a trader. But I think it depends on what your time horizon is. I've got my playbook. I just want to see it go lower.
Lee, you made a good point before on NVIDIA. Why not just ride all this out with Mag 7 names? It's hard to imagine that earnings estimates are going to be cut drastically at NVIDIA because oil prices are $120 a barrel or more.
Well, I'm glad you asked that question. I've been doing a lot of research with my young analyst, my Padawan Jesus, and we've done all this stuff with our little Bloomberg all week long. And the real time to buy is when you see oil start to crush, when you start seeing Tom make some money on the short side on oil. The real time to go knee deep, nose deep in that NASDAQ is going to be when you see oil get way below 90, start getting a couple standard deviations on the downside. That's when you want to start piling out of your value positions, and you want to double your positions in the Qs, if you know what I mean, and I think you do.
Tom, Lee, I've told you this before, but I'm going to tell you again, you both are my favorite to talk stocks with. Good to see you both. Have a wonderful weekend. I'll talk to you soon. All right, a tectonic shift in the federal government is underway. Education Secretary Linda McMahon has just launched a historic partnership to begin shifting the Department of Education's $1.7 trillion student loan portfolio to the Treasury Department. It is the boldest move yet in the administration's plan to dismantle the agency and return power to the states. But as the paperwork moves, The world is experiencing rising geopolitical risks. Operation Epic Fury has sent energy prices soaring and market volatility to new highs, leaving millions of student borrowers wondering if they will be able to repay their loans. I caught up with Department of Education Secretary Lynn McMahon to get more insight into these moves.
Brian, thanks. It's good to see you again. And actually, it's almost 1.7 trillion, if you can believe that. And, to put that a little bit in perspective, that is larger than the collective credit card debt in this country and twice the value of university endowments. I mean, that just gives you some idea of how really, truly big this is. And the fact that it was ever at the Department of Education, it makes me running the fifth largest bank in the country. I don't think that's what was ever intended at the Department of Education. If you were setting it up today and you were saying, well, let's create a student loan portfolio, your first thing that would come to your mind, I don't think would be education. I think it would naturally be Treasury. So as we have looked at where this student loan portfolio should actually be located, and I have had many conversations with Secretary Bessent, even during transition, before we were even in office, as to where this ought to be, because this is an outstanding portfolio of debt for the country, and it rightfully should be located at Treasury. So we have developed a co-administrative program. This is very thoughtful. We've had many meetings over the last 6 to 7 months, well, almost a year now, as to how this can best happen. So it's not we just pick it all up out of education and move it over to Treasury. This will be phased in over at Treasury. And so the first aspect that they're looking at is really the collection of defaulted loans. And they're well positioned to do that. And I'm really excited for this transfer, which eventually will incorporate all of the student loan portfolio. But at this point, we are co-administering it with Treasury.
Secretary, how will this portfolio be run differently under Treasury compared to the Department of Education?
Well, some of it is the same insofar as there are independent contractors that are utilized for loan servicing. Treasury has many more than we do. They will actually evaluate some of the ones that we have. We actually, in some points, we use the same of those contractors, but they have many more of them. Look, they have experience in collecting money. They are the IRS. They do deal with these contractors. So I think out of the chute, and given the fact that we've been working on this so long with them, they are well positioned to evaluate the contractors, make sure they have the right number of people servicing this loan debt, and to really get it where it needs to be.
If a student borrower is unable to make their payment, will the IRS take that out of their paycheck?
That's not the first phase of what they're doing. They're really trying. Look, the goal here is to get people back into repayment. 40% of these people, 9 million borrowers, are not paying. And I understand that. Under the past administration, with the Biden administration, there were so many mixed messages. The loans were going to be forgiven. This payment plan was going to be set up, on and on and on. And I think borrowers who owed money said, I don't know what to do. And why would I be repaying a loan if they're going to forgive it? I totally get that, but it's wrong. If you borrow money, you owe it, you need to pay it back. So our goal is to get people out of default, as is Treasury's goal. We want to make sure that they can buy a house, that they can get a car loan. And when you're in default, it's just such a negative on your credit record, on your credit score, that you're precluded from doing any of that. So the goal is get people back on a repayment plan, get them out of default. And under, the Working Families Tax Cut Act, there are really provisions in that to simplify this, so that now they're going to be really 2 repayment streams, not 9, not 10, but get you in a program that makes sense for you, and to have these account servicers that you'll be able to call in and talk to. And we actually sent out a letter, in conjunction with notifying everyone that this change was being made, a letter from me that says, that borrowers and parents and students, continue to call in to your loan servicer, because your payment schedule, if you have a good program already in place, let's continue that. Or how do we move into one of the new programs that are under, the Working Families Tax Cut Act, so that they can get up to speed pretty quickly.
Secretary, when we last talked about a year ago, I guess time flies when you're having fun. You told me, Brian, I'm going to try to close down the DOE in 4 years. Does this move keep you on track to close it, what, in now 3 years?
Well, you know what? I don't have a specific time frame. Clearly, the president's executive order to me is to close this. So his expectation would definitely be that it is within this administration. However, he moves at a fast pace and would certainly like to see it done as quickly as is prudent. And I think the steps that we are taking and working with other agencies and moving different programs in are thoughtful. They are common sense. It is where programs might have been located before, or where they can be located best now. We have, an incredible program that we started over at the Department of Labor in moving our Octay over there, so that we have WIOA and Perkins grant money already located there, and those grants are going out, and it's working beautifully. And I've actually been over and toured labor and talked with the people who are over there. So sort of that merger aspect that we're doing at labor has worked incredibly well. So we want to look at where the best place is for different programs to be located. For instance, I'll give you one other. Section 117 of the Higher Education Act requires that universities report money that they receive from foreign entities. Well, this just had fallen by the wayside. It wasn't being monitored. It wasn't being reported. So we created a brand new portal here at the Department of Education. But we have now relocated that over to the Department of State. And well, first of all, let me say it's transparent to anyone. You could go on this site and see where the money's coming from. It's that transparent. But we wanted state to have the opportunity to look at it and to flag, okay, maybe this is something we should take a look at. Is this, really foreign influence? What red flags does this send up? So those are the kinds of things and the kind of work and thoughtfulness that's going into moving these programs out. So we are doing it, I think, at the pace that you would expect. That's prudent for us to do it. We don't want things to fall through the crack. We want to make sure we've got the proper personnel that we are detailing to other departments under the co-administration portion before eventually Congress is the one who has to vote to make these changes permanent.
Coming up, a high energy chat with the CEO of energy drink maker Celsius. We'll be right back. Anyone that knows me well knows I love a good energy drink, or 7 each day, true story. And I'm not just drinking them in the morning to get me through the day. They have replaced other drinks in my daily routine, like water. And judging by the stock price and financials of energy drink powerhouse Celsius, I am not alone here in saying goodbye to water. The company just reported a defining year with record-breaking sales as it integrated acquisitions like Alani and Rockstar and saw more growth in the Celsius brand. The stock is up 35% in the past year. The wild card this year for Celsius and others in the space is a U.S. consumer now being battered by rising gas prices, perhaps leading to fewer discretionary purchases such as energy drinks. John Feely is the CEO of Celsius and has long been the driving force behind the brand. John, it has been a while. Welcome back to Yahoo Finance. Since we have last spoke, it has been a while. Your brand has exploded everywhere, notably in convenience stores. Who are you taking that shelf space from exactly?
Glad to be back, and cheers, Brian, to that. Cheers to Celsius. Bring the energy today for this, all your audience out there. And what's fascinating, we're expanding. We had an amazing portfolio, as you mentioned, with Celsius, Alani, and Rockstar. We have a modern energy portfolio today. Last time we were on the show, we had a singular brand, Celsius, and we're gaining space, shelf space, over 100% shelf space with Alani, and 17% expanded shelf space with Celsius anticipated. And that space is coming from a variety of categories, including teas, cold brew coffees. We're seeing premium waters as well get impacted, and the beer cooler in a lot of convenience stores is
taking
shrinking
share from
as
beer.
well.
Taking share from beer.
Not space, I would
Space,
say.
please.
Not
Space.
share, but space. What we're seeing, alcohol trends with spirits and alcohol reducing. Cheers to that. We're seeing consumers look for alternatives. We just did a study, and we saw within the energy drink category, and 33% of the consumers are drinking energy drinks during social occasions, where before it would have been an alcohol beverage of choice. Now it's energy drinks. So it's truly expanding. The category is growing. New consumers are coming in, and more females are coming in now than ever before. And that's a large segment of the Celsius Holdings portfolio that we're capturing.
You know the team at PepsiCo very well. I was just talking to CEO Ramon Laguarta a couple months ago. He's reinventing his whole portfolio, notably in the snacks business because of GLP-1s. I hear what he's doing there. How are you impacted by a movement like that?
Well, I think that's a massive opportunity for the category overall and the Celsius portfolio. So as GLP-1 becomes more prevalent, you need more protein. You also need more energy. And when you're looking for an energy drink, you want more out of your energy drink. And our Celsius portfolio and the Alani portfolio are really multivitamins in a can. So we're delivering more than your traditional energy drink, which gets us excited. And I think that health and wellness opportunity that is rooted in both of these brands, Celsius and Alani, is here to come and is going to continue to grow with GLP-1 continuing to grow.
The category has seemed to flown under the radar of the Make America Healthy Again movement, or MAHA. Why do you think that's the case?
Yeah, I think within that, health and wellness trends, it's on everyone's mind. The government's involved as well. Everyone, we need our healthcare systems. We need everyone to live healthier. Think about what they're putting in their body. Think about ingredients. Think about the amount of sugar that you're intaking as well, and fats within the diet. So I think that's getting everyone's mind on health and wellness, and that's where we're rooted in with the Celsius and Alani portfolio. Rooted in the gyms with Celsius, and Alani was born in health and wellness and health and wellness nutrition, and really a multivitamin that's helped really folks live a healthy, active lifestyle, especially geared towards women.
One of the benefits of being, now you've been around, you're an established brand now, John, compared to when we first got to know you and the company, you've seen some different economic cycles. Now, I know there's consumers out there that are dealing with rising gas prices. It's costing them $10, $15, $20 more to fill up their tanks. Have you seen them not go into that convenience store after filling their tanks over the past few weeks and not get that extra item that they probably would have gotten 2 months ago when gas prices were much lower?
Yeah, I think what we've seen historically, specifically in the energy category, it's really affordable luxury item. Goldman Sachs just put a report out that actually didn't have a correlation with increased gas prices and energy drink sales. So as well, so we think we're in a really good position. And when you look at it, your average coffee house that's around the corner, and you look at an energy drink like Celsius and Alani and Rockstar, it's a really great value opportunity as well. So we think we're fairly insulated with that. We have great flavors, great refreshing flavors, and enhanced vitamins. We're more than that coffee house coffee around around the corner that's, upwards to twice as much as our products are today.
Do you have to offer any promotions or discounts to keep engaged with the consumer that is laying out more for gas?
Yeah, well, there's a variety of pricing, promotional strategies that are in play. The category is on usually 24 to 26 weeks is like the promotional timing within brands within the category. But what we're able to do as a portfolio now is really leverage those pricing promotional strategies to increase the value of the overall portfolio, which is now over a 20 share in the energy category, which is massive and provides additional leverage and scale.
I have to pick my spots because we're running out of time here, John. I'm going to roll with this one. Have you reached the upper bounds on how much caffeine you could put into this? I'm looking at this Alani. This thing is 200 milligrams of caffeine. Why not make it 400?
Yeah, I think 400 is the maximum daily amount recommended by the FDA. We feel 200 is the right amount. We do have lower caffeine offerings. We have Alani Minis. And
no, I want higher, John. I want higher.
Well, we have our Celsius Essentials as well. That's enhanced caffeine. But we think we got the right amount. And, we're excited about the products we offer. We're expanding the category. Let's go.
All right, let's go is right. John, good to see you. Have a great weekend. Keep these products flowing. I know a lot of people
Thank
do.
you.
Appreciate it. All right,
Cheers.
Julie Hyman has you on the other side of the break.
Welcome to Market Catalyst. I'm Julie Hyman. 30 minutes into the U.S. trading day, so let's take a look at the major averages here. We are now about 3 trading weeks into the Iran war, and we've seen, of course, stocks decline, but not decline by as much as some might have expected. Right now, the Dow is off about 140 points, about 1/3%. The S&P 500 off about 0.75%. The Nasdaq Composite off about 1.2%. Just going back to the S&P for a moment, it being a Friday, it's a good idea to take a look at what we've seen over the course of the week, and we did see some strength earlier in the week that then melted away as things have gone on. Of course, we've also been monitoring the commodity markets very, very closely throughout the duration of this. Here's the intraday look at crude oil prices, WTI, that is, some volatility being expressed there. As we've consistently been talking about, this is futures, the actual cash spot prices for oil, especially coming out of the Mideast, are much, much higher right now. Right now, WTI futures at around $95 a barrel. Brent has been consistently higher, and there's been a lot of focus on the spread between those two measures. Brent, the international benchmark, WTI, that we price more here in the U.S., and you've seen Brent now above $104 a barrel. So we've been watching this closely. Here's a 6-day look at Brent here and the increase that we've been seeing. The increase in Brent, by the way, since the beginning of this conflict now stands at about 50%. Now, we've been watching gold as well. Gold having a little bit of a snapback today, very small one, but gold prices really rolled over this week in pretty decided fashion. This is the worst week for gold that we've seen in a couple of years. And the other metals, which had really been selling off yesterday, continuing to see some weakness today. Copper down 7% over the past week or so. Aluminum down about 5% over the past week or so. And going back to look at some of the other assets that we are watching here, we've also seen a big increase in Treasury yields. That's something that we've been seeing during this conflict because of the concerns over inflation. Here's the 10-year yield today at 4.3%. Here, I'm going to take a look at a year to date just to give you an idea of what we've been seeing. We had been seeing those yields come down, and now they've been coming right back up. Back to stocks here. What we see in today's session is continued strength in energy. That's been pretty consistent, not just during the war, but really since the beginning of the year. Today, tech is also down 1.4%. Consumer discretionary and real estate, those are the biggest drags on the S&P 500. And then looking at the Nasdaq 100, once again, we've got some pressure coming back into technology. So that also bears watching, because of its weighting within the major averages. So that's what the snapshot looks like here as we continue to see the effects of the Iran war. Let's talk more about what could happen next. Max Kettner is with us, HSBC Chief Multi-Asset Strategist. Max, it's great to see you. We've been talking a lot about how stocks have rolled over but not, plunged during this period of time, even with oil prices where they are. And perhaps the idea is that investors want to be positioned for when whatever this war ends, and thinking that stocks at that point will recover. Is that how you guys are positioning too?
Yeah, look, and thanks for having me, Julie. Look, I think when we look at actually our positioning indicators, they are showing a bit of signs of capitulation when we look specifically at the risk on spectrum. When we look at the likes of equity and credit, we look at things like the VIX futures curve, for example, that has been flashing buy signals for quite a few times over the last 3 weeks. What makes it tricky, I think, for us is that it's basically a sell everything, basically a sell assets environment. So if we look at the last 3 weeks, would the Swissy have helped me? Would going long the yen have helped me? Would, even the dollar has been sort of sideways now the last few days, right? A bit choppy, a bit up, a bit down. Wasn't the ultimate portfolio hedge, but all the safe havens, whether it's US Treasuries, whether it's gold, whether it's the Swiss franc, the Japanese yen, none of the safe havens really work either, because it's basically just a sort of a whiff of stagflation that's going around. So I do suspect what you've got probably as the sort of the next big move, once we have some sort of relief rally, that actually correlations will remain pretty high in that environment. It's actually then switching from a sell everything to almost a buy everything environment, where gold benefits, where the Swiss franc, Japanese yen, equities, but also US Treasuries, where everything then breathes a sigh of relief. That's a little how we are positioned. We have been leaning over the last week and a half. We've been leaning back into European equities and into Asian equities in particular.
Max, all of this seems to be a bet, A, that the war is not going to be enormously protracted, and B, that what's going on is not going to tip global economies into recession. Are those safe bets? Are those good bets?
No, those aren't safe bets, right? I mean, by definition, I would argue any bet isn't particularly safe. But look, I guess from my standpoint, it depends what seat you're in. It depends really how you're trading. If I'm trading day in and day out, if my seat is mark to market really hourly, or I'm really assessed on a weekly basis, I think my view would probably be not overly cautious, but it would be most of the time neutral, be very nimble, and take very small positioning sizing. If you've got a view like ours, which is more sort of a 6-month view, a 6-month tactic view, then we're talking, Julie, right? We're talking exactly about what you've just asked. Is that really going to leave sustained scarring in the economy? Or is that something that is comparable to, let's say, Liberation Day, or something like COVID, where perhaps really the market and investors are a little too focused now on the level of economic activity, the level of damage that's being done. Whereas I would argue, go back to 6 years ago to COVID, I would argue, even though most of the high frequency data people were tracking, remember people were tracking restaurant bookings and credit card data and mobility indices, all sorts of funky data sets. By the time things were properly back to normal, that was only around the summer 2021. By that time, the S&P was already 50% higher, because what really mattered was the rate of change. What mattered was that things were getting less bad. And that, I think, is probably sort of the next big thing. It doesn't need a ceasefire agreement. It doesn't need a peace agreement for things to rally. It just needs the sort of first tiny news that is less bad for things to start rallying again.
Well, Max, I think we also need to sort of take a step back. Pretend the war didn't happen and talk about what the backdrop was before all of this, right? In order to, if we're coming back to where we were, if things have to get less bad, so less bad to what? In other words, do you know what I'm saying? In other words, what was your outlook for stocks this year before this war even happened?
I mean, I'm very happy about that question, because you're genuinely one of the first people in the last 3 weeks that actually asked, what is your view? Let's look at a couple of charts, because it does feel like an environment where, charts and models or any kind of fundamentals really are taking a backseat for now. But I would say, heading into this, what we've really seen was a bit of a re-acceleration in the data. When you looked at, particularly in the manufacturing-driven economies, the open economies globally. So in Asia, it's the likes of Korea and Taiwan, like Thailand. In our spheres, right, it's the likes of Czech, like the Netherlands, like Sweden. Actually, all the manufacturing leading indicators were picking up in the prior 3 months. What that means to us, once we get back to some sort of normalcy, hopefully quite soon again, that we want to be leaning back into sort of the industrial complex there. That means for us, for example, something like OMX, like the Swedish equity market, which is heavily dominated by industrial companies, that is really then worth looking at again.
What's really interesting is what you're not saying, which is AI, Max, right? Because that, at least here in the U.S., right, has been the bedrock of the bull case over the last couple of years. Although, as we know, there have been some substantial holes torn in that, notably in software. But even more broadly, some concerns about whether there is peak capex, what the sort of trajectory of adoption is going to look like, and ROI, all of that. So how are you thinking about that question then? As your enthusiasm is clearly about more on the manufacturing industrial side.
Yeah, it's more enthusiastic on sort of the broadening and the industrial side of things, right? The cyclical side of things. That does not mean that I would say, wow, once this is over, hopefully, that means I'm going to go short AI. No. What it means is that there's just a bit more tactically, a bit more exciting opportunities elsewhere, I think, in the cyclical sector. Now, on the AI story, let's not forget that a year ago, people were arguing, wow, it's only 7 stocks that are driving the US equity market. That's really unhealthy. And just before the Iran conflict kicked off 3 weeks ago, the argument was that the broadening and the fact that those 7 stocks do not participate as much anymore, that's also really unhealthy. So in my mind, it's a bit like, wait, so equities going up driven by 7 stocks is unhealthy. healthy. But if it's the broader market going up unhealthy, it's also unhealthy. So does that mean that stocks going up is just in general unhealthy? That's sort of the arguments that don't really make an awful lot of sense to me. Or on the capex side, it's the same thing. I remember in the 2010s, really up to 2022, a lot of the arguments against the US equity market on a structural basis was, of course, coming from this excessive valuation, or the allegedly excessive valuation, because US companies invested less. Capex were actually perennially lower, right? Particularly in the 2010s. Now, for the first time, we do have capex, we do have companies investing, and now it's also bad. So sometimes I'm a bit wondering, right, is there only a sort of, you do this, it's bad, you do that, it's also bad? I am wondering on the AI side if people are not missing that actually over the last 5 months, given that AI names are broadly flat to slightly down, but valuations have come down so much that the Mag 7 are now almost as expensive as the Russell 2000 as small caps. That genuinely means that I think particularly longer term from a valuation perspective, really AI does look more attractive.
Okay, so to be clear, you are bullish, if people aren't gathering it from what you're saying, on equities, whether it's industrials, maybe the AI trade as well, equities broadly. So, okay, so I guess I'll take the other side of that. You're talking about folks who seem to like poke bearish holes in things no matter what. I'm going to ask you as a bull, what could go wrong here that would put your bullish case at risk?
Yeah, I do think if we see this conflict sustain for another couple of weeks, I think if we do go into April, well into April, if oil really does approach the 150s, that really takes our bullish case probably really on the thread, simply because then you will probably see increasingly a threat to economic activity. And then it's not like it was, for example, Liberation Day, where you could argue, well, this is only a temporary thing, and let's look through some of the activity and some of the leading indicators like the purchasing manager indices for the next month or two, because we've already moved on to a new world where we know there's going to be some sort of tariff deals. That is then really a new world where we're saying, well, this is actually not temporary. This is now going to affect genuinely activity. And that really would then, I think, from an earnings perspective, really put our bullish view, I think, from an earnings and from a growth perspective, really under threat.
Well, we will check back in for sure. Max, it's good to see you. Thank you. Coming up, we'll talk about the private credit market, the status, and whether Wall Street's fears are overblown or not. We'll be right back. Private credit strains have rippled across Wall Street in recent weeks. Our next guest says the data show that fundamentals are sound. Joining us for more is Ruth Yang, S&P Global Ratings Global Head of Private Markets Analytics. Ruth, I'm so glad to have you here because we've been talking about this a lot. And I think there is a lot of confusion on the topic, right? There are a lot of headlines about people trying to pull their money out of these various private credit funds. So what can you tell us? And I know this is sort of the high level view of what's happening in private credit markets and how much risk is there right now. What can you tell us?
Yeah, I mean, you can't. First of all, thank you for having me on today, Julie. I mean, I think that there is pressure on credit markets across the board, whether you're talking about bond borrowers, broadly syndicated, or private credit. The pressure, as we think about potentially eroding consumer purchasing power, inflation, employment, the risk of recession, as the situation in the Middle East may be prolonged, we recognize that this could have a long-lasting effect on the economy and credit conditions overall. When we think about private credit, it is also tends to be a more speculative grade, younger companies, companies who have lower cash flow that have been or have there's less transparency on valuations and there's a lot more opacity, which I think really creates a lot of concern about what's going on. However, through our credit ratings, our credit estimates on direct lending smaller companies, we do see, to your point, that credit technicals remain relatively consistent and sound, and we are not seeing any alarm bells for a rise in default rates or any particular risk in the near-term future.
Ruth, just to take a step further back here, we have seen a huge increase in the private credit business in the past several years, right? Did this debt just not exist before? Did these entities, were they not able to get these loans, or were the banks doing them?
So, private credit lending and lending to SMEs is really a long-standing part of our economy. It, dates back to actually 1980, which was when the BDC structure was created. What we've seen, particular over the last 15 years since the Great Financial Crisis, is a significant scaling up in size and sophistication in this market, right? So it used to be just to SMEs. It used to be whether it was a bank lending to it or it was an alternative asset manager, a sponsor lending to these companies and buying them. It was mostly to small companies less than $30 million in size. What you've really seen is through the enormous amount of fundraising capacity that the AUM, that private equity has raised, their capacity to fund larger and larger transactions has grown significantly. So it's really stepped more into the general market view. And then the size of assets that are available to institutional investors has grown significantly over the last 15 years. And of course, we've seen a massive growth in BDCs available in multiple formats. We have, openly traded BDCs, we have non-traded BDCs. There's a lot of different structures. So this is a long-standing part of the credit markets. Where it's really changed is it's just grown in availability and funding size to general markets.
And by the way, for folks who are watching, BDC, Business Development Corporation. So as somebody because these are opaque instruments, how do you even determine what the risk is? What tools do you guys use when you're trying to figure out, whether there is a default risk for a particular instrument?
Yeah, absolutely. So through the credit rating process, we rate middle market CLOs. And through that process, we have what we call a credit estimate, which is a point in time assessment of the asset. So every asset that goes into a middle market CLO that we rate, we provide this point in time credit estimate so that we understand the assets in the structure. In our universe, we have over 3,600 direct loans that have a credit estimate on them, and they represent close to $800 billion of the private credit market, which, we estimate is about $1.7 trillion in size. So we feel like we have a pretty good view into what is going on in the credit performance, and we keep a close eye on them. We watch how well they are performing over time. We look at their default rates. We are able to monitor how they perform. And through that lens, what we really see is that liquidity levels, debt servicing capacity, and the overall technicals in these credits have remained quite strong over the last couple of years. They have withstood the challenges of the transition to a higher interest rate environment, as well as the volatility of the economy, particularly over the last year. Year-over-year coverage ratios, revenue, EBITDA have actually improved because the economy has been fairly resilient.
So the other big change that has happened in this market has been more retail exposure to these products. And that's because retail investors are being marketed to with these products a lot more aggressively. And so some of the recent issues also seem to be that some investors want liquidity, right? They want their money back. And the structure of these vehicles is such that they can't always get all of their, all or any, in some cases, of their money back. So I'm curious how you think about that tension, because as you know, there's the fundamentals of a particular instrument, and then there is the sentiment around it, and sometimes one can affect the other.
Absolutely. So I think when you look at the situation, it's a kind of it's a multi-dimensional issue, right? Which is through what's going on in credit markets in general, there is concern about credit quality. Because these are opaque in illiquid assets, the pressure to redeem is very high right now because people are concerned about upcoming losses, the potential of a rising default cycle, right? And so to your point, the liquidity pressure on the BDC structure is such that a lot of investors are saying they're withdrawing their money. The challenge really is these are illiquid assets sitting in structures that offer liquidity but not full liquidity. And the importance of liquidity in any market, particularly private credit right now, is this mismatch, right, between the investor's ability to exit and then the illiquid nature of the loans. This has really been a test of the liquidity structures of the funds that allow redemptions. Different fund types have different redemption structures. So for retail investors, this rise in redemption requests, really, it's a reminder that liquidity is easy and it's highly valued. It's easy when market conditions are easy, but it's highly valued in times like this where there's a lot of volatility. Every BDC has its liquidity rules, and it has a lot of them have gates, right, which is what we're seeing being triggered right now, or they're coming in, or they're potentially being triggered right now. And this is really a question of how much liquidity under pressure the BDC will provide immediately. And then they may slow redemptions just in order to manage the assets better, because they are illiquid. Like selling them under pressure is not necessarily in the best interest of investors either.
Right. So I guess the lesson here is what the lesson is for most things that people are investing in, which is know what you're buying and read the fine print. Truth.
We believe in education very strongly.
Yes, exactly. Thank you so much. Really appreciate it.
Thank you, Julie.
Coming up, we're going to look ahead to CERAWeek. The energy conference could not come at a more important time. I'll be there along with one of my colleagues. We'll give you a preview next. some of today's trending tickers. We are watching FedEx, Supermicro, and Planet Labs. First up is FedEx. Those results beat top and bottom line Wall Street estimates, and the shares are higher today. We've got them up by about 2.4%. FedEx also raised its guidance for this year, and the upbeat outlook shows that the company expects to withstand the unfolding impacts of the war in Iran. Analysts were also concerned about the impact of soft consumer spending, rising energy prices, but FedEx CEO stressed the demand trends, he said, fundamentally have not changed. Next up, this is quite a story today that we are watching. Supermicro shares, they are plunging. The server maker's co-founder was arrested along with two others. Actually, I think one of these people is still at large. U.S. prosecutors allege that Supermicro employees smuggled AI technology to China. Now, that smuggled technology in question, NVIDIA-powered servers worth billions of dollars. The indictment says that violates U.S. export controls. Supermicro says the company isn't named as a defendant, but its co-founder does work as an executive in business development, and the indictment marks one of the biggest chip smuggling cases since the U.S. restricted NVIDIA shipments to China back in 2022. Those shares are plunging by some 28%. On the flip side, one of Supermicro's main competitors in this server market is Dell, and those shares are higher. I've seen some analyst commentary suggesting that over the longer term, Dell might pick up more share as a result of this. And finally, we got Planet Labs. Those shares climbing, the company reporting revenue that beat Wall Street expectations. It's a satellite imaging firm, and it also raised its outlook. Geopolitical tensions are spurring demand for its services. The CFO pointing to the growth of defense and intelligence sectors, with tensions driving, quote, a sense of urgency in governments. Planet Labs was selected as a prime contractor by the Pentagon's Missile Defense Agency earlier this month. It also has a multi-year deal with the Swedish Armed Forces. Well, coming up on next week is CERAWeek, which is the oil and gas industry's biggest conference, at least the biggest one here in the United States, and obviously coming at a pivotal time for the energy markets. I will be going, as will my colleague Jake Conley, who is here with me now. And obviously, there is a lot to talk about just on the oil and gas front with the Iran war sort of reshaping, remaking in real time as we watch what's going on. And the executives who are there, who are the executives at some of the biggest oil and gas companies in the world, there are a lot of questions for them, right, about whether they're going to increase production here in the U.S., as the White House reportedly is pressuring them to do, and just how they're handling this whole conflict.
Yeah, that's exactly right, Julie. As you point out, this is reshaping what we think of as the energy market in real time. Gas, oil, derivative products like jet fuel, all of this is reshaping what's going on. CERAWeek could not be coming at a bigger moment. You'll have the CEOs, as you said, of the biggest energy companies in the world, along with some of the policy leaders. Chris Wright will be there. Several others in the administration will be there. Several of the biggest thinkers in the space will be there. All of this is going to be revolving around now what's going on with Iran. I think 2 months ago, you and I were saying this story here is going to be AI. It's going to be power demand. It's going to be electricity. That is not true anymore. Now, the only thing people are going to be talking about, really, especially on the sidelines, is Iran and what's going to happen.
And I thought it was interesting because there was some chatter yesterday. There's so much to follow. A couple of things I want to mention. There was some chatter over the past couple of days that the U.S. was considering some sort of export ban, that we wouldn't be able to export petroleum products. Chris Wright, who you mentioned, who's the energy secretary, came out and said, no, there's not going to be an export ban. He is the first person to speak on Monday morning. We're going to be listening very closely to that to see how the administration is thinking about how they can mitigate the effect of the war, because so far, everything that they've done, whether it's announcing releases from the Strategic Petroleum Reserve to pulling back on sanctions on Russian oil and even Iranian oil, it hasn't really changed what's going on in the oil markets.
I think you're right about Chris Wright being a real focus here. Who knows if he's going to make news in the room that morning, but his comments will be watched regardless, because he's going to be expected to comment as the administration's forward face on energy on Iran. To your second point, the U.S. has struggled to contain this, and part of the problem is just how this energy market is set up, right? Oil is global. We know that. It's priced globally. Everything that happens overseas impacts us here. It's why gas prices are averaging almost $4 a gallon here in the States. At the same time, WTI, the U.S. grade, is trading pretty far below international grade because our system is a little more supported. by the US industry, by where we get our oil from. A lot of our oil comes from Canada, which is not being impacted right now. You saw the US remove Jones Act provisions, trying to make transport cheaper. You've seen them do a few other things, remove sanctions on barrels.
Yeah.
It's not clear if any of this is really going to have an impact. The export bans problem that you're going to hear from the industry is that it's going to hurt the US producers who the US administration is trying to get to pump more oil right now. Because if you have an export ban, if you can't sell your crude, then why are you going to pull more out of the ground? It's going to force backups in storage. That could back up to Canada. It's got a really long tail of events that I imagine the energy CEOs who went to the White House yesterday were saying, please do not think about an export ban. This is not going to go the way you think it is.
Right. Okay. So that all of this is going to be a hot topic of discussion. At the same time, as you said, when we were going in, we were talking about this months ago, our thinking really was that this is a power story. And that story is still intact. We will be talking a lot about oil and gas, but we're also going to be talking to some CEOs who are squarely on the power side of that equation, including Scott Strazik of GE Vernova. We're going to talk to Vimal Kapoor over at Honeywell, who is both. All of these companies are also affected by what's going on with energy, but they're also trying to play into the data center build. Joe Dominguez over at Constellation Energy. And so we're going to be having a lot of conversations, too, about the AI build out and where that power is going to come from and the effect on all of us in the form of electricity prices, which have already been going up.
Well, the U.S. consumer is now getting squeezed in both ways, right? You're paying at the pump, and you're also seeing your electricity bills tick up as AI becomes more prominent, as these data centers get built, as they draw more power. You're absolutely right. AI is still going to be a huge portion of this event. You see a bunch of talks scheduled on it. You and I are going to be talking with a lot of these CEOs and industry leaders. And the question I think they're going to be getting is, how do you tackle the affordability issue, especially if these gas prices stay elevated?
Yeah.
And now the oil and gas industry, you saw Chevron working with some data centers to provide power. Not that that's necessarily going to slow down, but does it now take a back seat to the priorities of making sure their global operations, their domestic crude production stay steady?
Right. And a lot of these companies, a lot of the hyperscalers are saying we will pay for it. We'll see if that convinces some of these local places that don't want data centers there. We'll see. Jake, I'm looking forward to the trip, and stay tuned for our big conversations and our reporting from CERAWeek. But in terms of those CEOs, again, we'll be speaking with CEOs of Honeywell, GE Vernova, Constellation Energy, and more. Coming up next, we're going to talk about the space race with the CEO of Firefly Aerospace. You're watching Market Catalyst. Firefly Aerospace reported record revenue for 2025, growing 163% year over year. Comes about a week after the company's successful Alpha Flight 7 launch and about 7 months after the company's IPO last August. Joining me now, Jason Kim, Firefly Aerospace CEO, to talk more about the numbers. Jason, really appreciate you being here. And you know, the numbers were strong. It seems a little like a come down after the launch that you guys just had, I guess, from an emotional perspective. But talk me through the numbers here and what were the biggest drivers, and then what you're looking at now for the remainder of this year.
Thanks, Julie. We had a transformative year in 2025. We were the first commercial company to successfully land on the surface of the moon, and we performed the longest number of days of a mission for NASA, 14 days. And we had 10 NASA payloads on there. We brought down 120 gigabytes of data. So it was an incredible achievement. But we also had our successful historic IPO on August 8th, which gave us a lot of cash on the balance sheet and gives us a lot of runway to grow. In addition to that, we acquired a AI company called SciTech in October of last year, and that really bolstered our national security defense work, in addition to is very important and strategic for orbital data center strategy as well. So those kinds of things really drove 2025, and the momentum carried on into 2026 with a successful Flight 7 of our Alpha launch vehicle. And that was a flawless launch. And we anticipate and are targeting 3 more launches this year of Alpha.
And Jason, I believe you were there in mission control, as it were, when that rocket was going off. I mean, talk to me about what that was like. We see all this stuff in the movies, right? When NASA has had rockets go off. How is it different when it's commercial space flight, and sort of what was that like emotionally being there as the rocket went off?
Well, this rocket is very special. It, in 2023, performed a record-breaking launch in 24 hours for the Space Force, shattering the previous record of 21 days on a tactically responsive space launch. And every launch we've had is always basically mimicking that responsive launch. So this was no different. We launched at the first instance of the launch window, and it was flawless. I was in the control room with the rest of our team, and they were calm, cool, and collective. We had a first stage that was nominal in performance, a second stage that was nominal in performance. We did a relight of our second stage engine, and then we deployed a Lockheed Martin demonstrator. And so it was successful. And, it's really important because this was our last Block 1 Alpha rocket. Mm-hmm. We de-risked a lot of the technology that will fly on our upgraded Block 2 rocket that will be later this summer.
So you guys have that business, obviously, which is very important to you. You mentioned that SciTech acquisition. I think you closed close to the end of last year. And this is software that is used in incoming missile detection, is my understanding. Is that technology that is currently being used in the conflict in the Mideast?
Absolutely. It was operationally accepted by the Space Force last September. And so it's been in operations for several months. In the first 30 days of the Iran conflict, Forge by SciTech, our subsidiary, processed over 1,000 missile threat messages and is really keeping our U.S. and our allies safe. And it continues to do that with modern AI software, force multiplying each Space Force operator in the 11th Space Wing so it could support the conflicts around the world.
So, Jason, this stuff is obviously very cool, just from a layman's perspective, between rockets and missile detection. You have this, more than doubling in the business. And yet I look at the stock, and it has come down quite a bit since that IPO, right? It's down about 50% from the IPO price. What do you think the market is not getting about your business, or what message are you trying to put out there?
Well, I think the market is starting to understand that we are an end-to-end full service provider in space. And so we have the entire ecosystem to launch satellites, build our own satellites and lunar landers, and do on-orbit processing using our SciTech algorithms. So it's really a capability that's end-to-end. There's a lot of tailwinds that are just now catching up with where we have been going. Things like the moon, the new NASA administrator, Jared Isaacman, wants to go to the moon's south pole with robotic landers, such as our Blue Ghost lander, every month starting in 2027, next year. And then in addition to that, there's orbital data center emphasis that is springing up. And everything we're doing with SciTech on the ground with orbital data, ground-based data centers is transferable to orbital data centers in the future. And then finally, our rockets, whether it's our Alpha rocket, that's the only 1-ton rocket on the market that can that has orbital flight heritage, that we're going to rate up with our Alpha rocket. And we're also, everything we're learning from the Alpha rocket is reducing risk for our medium lift vehicle Eclipse that we're co-developing with Northrop Grumman, and that's going to be able to launch constellations in the future.
So Jason, all of this, again, very cool, implies a lot of growth here. At the same time, it is not a low-cost business. You guys burned, I think, $79 million in cash in the fourth quarter. You're planning to increase CapEx this year. When do you see that cash burn start to sort of decrease or be mitigated? And when do you expect to go free cash flow positive?
The drivers to that goal are launch cadence. And, we're going to launch Alpha 4 times this year, and then we're going to steadily improve our launch cadence on Alpha year to year. And as we get more launches, we'll be able to get EBITDA positive. In addition to that, our SciTech business, they do a lot of national security work. And a lot of those tailwinds in terms of the Iran conflict and Golden Dome, SciTech is well positioned for those very lucrative contracts.
Jason, thanks so much. Really appreciate it.
Thank you.
Coming up, how to handle your household finances with these higher gasoline prices. You're watching Market Catalyst. We'll have that next. The ripple effects of the conflict in the Middle East are already showing up in rising energy prices in the U.S. Let's look at how you can weather these impacts and how you can protect your household finances. Joining me now is Catherine George, financial advisor at WealthStream Advisors, for this week's FA Corner, brought to you by Capital Group. Those gasoline prices getting close to $4 a gallon, Catherine. So if people are thinking about allocating, that they're going to have to allocate a little bit more to gasoline, how should they be thinking about their sort of holistic budgeting to try to account for that?
Yeah, I mean, I think we've been dealing with rising costs and prices for a while now. Eggs was the big topic a while ago. Now it's gas. So I think consumers have been having to think about their expenses for a while. I'd say cash is the number one strategy in making sure you have a cash reserve on hand. So thinking not just about today or this month, but 6 months, the next year, sometimes even the next 2 years down the line, do I have enough cash on hand to support these extra costs, to support any emergencies that come up, or any one-time expenses like a car or anything like that. So planning in advance for those types of things can really help you not look at the portfolio and be so invested in that day-to-day up and down.
And Catherine, when you talk about people having cash on hand, do you mean like a deposit account at the bank, or do you usually recommend people, say, do money market funds so they're at least earning a little bit on that money, but they can get it when they need it?
Yeah, of course. There's lots of ways to get some higher interest rate on your cash. One option is money market, like you said. For longer term cash, you could even do Treasury bills, but even a simple online savings account. So there are types of online, just regular bank accounts that have higher rates because they don't have the same costs as some of these brick and mortar banks. So that can be another easy option for people as well.
And then another thing we recommend is people having their assets sort of diversified, which I guess is a good idea anytime, but especially good when things are a little rocky.
Yeah, so having a plan in place before turmoil occurs is always important because the place that we're in now, the assets that everyone assumes are going to benefit from the war, or last year it was the trading costs. So those assets don't necessarily move in the way that we think they will, and they've already taken into account all of the information that we have. I was just reading an article this morning that said if you didn't buy the umbrella when the sun was shining, that protection is going to cost you a lot more today. So preparing the portfolio in advance, that means having not only just these tech companies that have been so dominant over the last few years, but also small U.S. companies, medium-sized U.S. companies, and international and emerging market companies. Those types of assets have actually done very well last year, and even this year, they're outperforming the U.S. So, thinking about these things and having a plan in place so that you can be protected when things are volatile is really important.
And Catherine, what should people not do right now as they're seeing their costs go even higher?
Yeah, I think reacting. I think anytime there's these headlines or we think we can have some sort of control, we want to take action. And as long as you have a plan in place like that cash, diversification, if you're planning, not making these drastic changes is really important. Like I was just talking about before, not trying to bet on what is going to perform based on what's happening because we don't know how things will react. And you might just be paying overpriced, if you are going to be doing what everyone else is doing. And then if the market does drop, there are silver linings. If you're in a high tax bracket, you can do something called tax loss harvesting. And so taking advantage of those tax losses, you can sell an asset and buy a very similar asset so that you're not out of the market. And then you get that tax loss, but you're not losing out on any of the market in the meantime. So that could be a really big tax win. And rebalancing, you can always rebalance your accounts right now. So if you have those target allocations, making sure that they are where they're supposed to be is great.
Catherine, thank you so much. Appreciate it. And that was FA Corner, brought to you by Capital Group. That does it for Market Catalyst. I hope everyone has a fantastic weekend. I'm Julie Hyman. More Yahoo Finance is coming right next.